Right, so there are plethora of options for one to invest their money in, but picking the right one that suits your financial goal and your risk appetite is the key. One of the main tool while making a decision to invest in a mutual fund is knowing your fund's manager strategy. Now, with an aim to help you connect with the fund managers and understanding their investment strategies, we present to you Meet Your Fund Manager episode, and in today's episode, we will be joined by Bhavesh Jain, Edelweiss AMC, who manages Edelweiss Balance Advantage Fund with a lot of other funds as well. The scheme was launched on August 2009, and has an expense ratio of 1.77% when compared to the benchmark, which is Nifty 50 index. The scheme has managed to outperform periodically. Bhavesh, welcome to the show. Let me start with a very basic question. The Balance Advantage Fund or Dynamic Asset Allocation Fund category is gaining momentum. It allows you to maneuver across asset classes like debt and equity. Now, what's been your recent strategy for this fund, specifically if I talk about 1 year time frame?
Thanks for giving us this opportunity. Yes, if you'll see, Balance Advantage Fund as a category is one of the fastest growing category in last now almost 6 to 7 years, especially after taxation of debt changed in 2014. This is the period after which all hybrid schemes, including Balance Advantage Fund, Arbitrage Fund, Equity Saving Fund, all of them picked up. We were fortunate enough to be there in this category at that point of time. So in 2016-17, our AUM was around, you can say, 250-300 crore, and today as we speak, it is a 9,000 crore fund. In this period, say almost now 13 years of live track record, the strategy which we follow has been consistent. We are going with a trend-based asset allocation model. If you will see, most of the fund in this category are on the basis of valuation, whereas from day one, we have a belief that Indian markets are a highly volatile market and it is a high beta market in a global scenario. And that's why our market rarely will trade at fair value, and it will always be either you can say overbought or oversold. And that's why we want to go with the trend. And the model which we follow is known as Edelweiss Equity Health Indicator, and it is purely a trend-based asset allocation model.
Right, so what is the indicator indicating now? What does it say now?
So again, right now you will see within Balance Advantage Fund category, you will see different funds running different net equity allocation. And I think we will be one of the, you can say the most, fund with the most aggressive equity allocation, because are extremely positive. We are running close to 69% equity, net equity today. This, if I'll compare with category average, the category average will be somewhere around 45 to 50%.
Bhavesh, now if we leave 1 year fund performance because it's been below the average category, but 2 years, 3 years, the fund has really outperformed. What happened in this 1 year's time?
So as I said, the strategy which we follow is trend-based asset allocation model. And now for last 1 year, practically if you will see, we were at 18,200 last year in November. Today as we speak, we are again at 18,200. So almost for 1 year, Nifty has given you hardly, you can say 1 or 2% return. That is no trend in market. And as the name itself suggests, our model is trend-based asset allocation model. So in a non-trending market, we tend to underperform. Historically, if you will see, 75% of the time, that is 3 out of every 4 years, markets are trending, which is suitable to our style, and 25% of the time, that is 1 out of 4 years, markets are non-trending. We see a lot of volatility, but finally clients are not making any money, markets are not going anywhere. In this kind of year, we tend to underperform. So this happened in 2018. Before that, it happened in 2015. So you can say once in every 3 or 4 years, this kind of market comes, wherein we underperform the category by say 1.5 to 2% on an average. But in the year where markets are trending, that means the year where markets are giving you double-digit return, either 2014, 2017, 2019, 20, 21, or negative year like 2008 and 2011. Whenever markets will give you double digit, that is trending positive or negative return, we outperform the category on an average by 5 to 7%. So we are okay, or we are happy to underperform in a non-trending year by 1 to 2%, because we know 75% of the time markets will be trending, and in those trending years we will more than cover whatever we lose in this non-trending year.
An aspect you've touched, because a lot of investors, I mean, we usually advise investors to stay in equity mutual fund with a time horizon for 3 or more than 5 years time period. But then, given the fact that there has been an underperformance since almost a year, a lot of investors might just want to exit the fund. What would you tell them or explain the entire thing in very simple language as to why should they hold on to this fund for maybe more than 5 years or a longer time frame?
So even after having a year wherein Indian markets have hardly given you a couple of percent as return, even now you look at 3 year, 5 year return, it's a healthy double digit return. And within that, if you will see our fund in last 3 year and last 5 year has given you returns in the range of 12 to 14%. Now, the basic problem any investor want to solve over a long period of time is to give equity like return with much lower volatility and much lower drawdown. So that is something which we want to achieve. Today, if you will see an average large cap fund, average large and mid cap fund, or an average flexi cap fund is on a rolling 5 year basis is giving you returns in the range of 10 to 12% with a volatility of almost 20% or drawdown of almost 40%. Now, this if you will compare with Edelweiss Balance Advantage Fund, we are also giving you return in the range of 10 to 12%, but with a volatility of only 10% compared to the 20% in your normal funds, and a drawdown of around 14 to 15% compared to a drawdown of almost 35 to 40% in your normal long equity fund. So here is a fund which is very simple in nature, which over a period of time is giving you equity like return with a much lower volatility and much lower drawdown. I think earlier people used to think that balance advantage fund is a tactical allocation. It is suitable to only your retired client or someone who is coming into equity for the first time, or someone who is looking only for steady cash flow. But I think there is enough data which has been provided by this category in last 5 to 10 years, which shows that it is no longer a tactical allocation. And in fact, balance advantage fund should be part of each and every client's core portfolio, whether it is an aggressive client or a conservative client, an old retired person or a fresher coming into equity for the first time. For all set of investor, a 20 to 25% allocation in balance advantage fund will solve most of his problem like higher returns, lower volatility, stability, consistent cash flow. All these problems will get settled just by putting one single fund. And then that's why we say that don't look at short term performance. Any market, any strategy, any fund will have that 6 month, 1 year wherein there will be no performance. But if you are coming into equity, you should at least come with a 3 to 5 year horizon. And I think most of the time period, if you look at rolling 3 year and rolling 5 year return for our funds, we are comfortably outperforming the category with a much, you can say, decent margin and a much lower volatility and drawdown.
All right, let's talk about the breakup, the category breakup. Now, equity has almost 60.31% and debt you're talking about 26.16%. What exactly the breakup in equity in terms of sectors and your investment interest areas?
So I think, the number which you are talking will be our net equity exposure. The equity portfolio we construct is our gross equity. So for every 100 rupees which we get, 80 goes into equity and 20 goes into debt. This 80 which goes into equity is managed dynamically depending on our, as I told you, the model which we follow, that is Edelweiss Equity Health Index. Our equity, net equity can be anywhere between 30 to 80%. Now, because this fund is supposed to be conservative in nature and protecting downside is our primary objective, it will always be large cap biased. So out of the 80 rupees which goes into equity, almost 65% goes into large cap, that is top 100 market cap company. Around 10 to 12% goes into mid cap, that is 101 to 250, and remaining 3 to 4% goes into small cap, that is 251 to 500 market cap company for us, because our investment universe is NSE 500. As of now, you will see the largest sector in our portfolio is in line with the benchmark. So we will be, the biggest sector in our portfolio will be banking and financial services, followed by IT and other sectors. As of now, I think we are overweight on some of the economic recovery theme. So you will find overweight position in PSU banks, some of the, you can say, cement sectors and some construction companies. These are the few sectors where we'll be overweight, and we will be slightly underweight on, you can say, defensive names in this current environment. But I think overall net equity is decided or determined by the formula or the process which we follow, wherein most of the players in the market are on the basis of valuation, whereas we are purely on the basis of trend. That's why our net equity exposure today as we speak is around 69%.
Are you concerned about the large cap underperformance and which also takes down your performance as well? How long do you think it's going to sustain and it's going to pick up? What is the outlook out here from you?
So I think it is a tricky question for me because I am fund manager for both our large cap fund as well as our balanced advantage fund. But I think more or less even we are getting convinced slowly and steadily that instead of large cap fund, balanced advantage fund will become a much better category because as I told you today, our balanced advantage fund is able to outperform average large cap fund with 50% lower volatility and almost 60% lower drawdown. So finally, if you think from a customer points of view, this is something which we require. Return wise, today the average large cap fund and balance advantage fund doesn't have a big difference, but volatility and standard deviation and then you can say drawdown, I think balance advantage fund easily beat any large cap fund on this parameter. Again, as I told you today, generating alpha in large cap category is becoming more and more, you can say, difficult task, and that's why you need to either move into, you can say, funds like index or into funds wherein some thematic plays will be there, like you can say a momentum based fund or a volatility based fund, or you can say different factor based funds which are getting launched slowly and gradually. You can look at those funds. A plain vanilla large cap fund will find it really difficult to outperform even you can say Nifty index on a TRI basis.
What about the debt allocation that we're actually talking about? What's in it?
I think the most important part in any hybrid fund, may it be arbitrage fund or equity saving fund, or for that matter, balance advantage fund, I think the most important part of the portfolio is fixed income portfolio because equity will have short term pain, short term volatility, but debt will have permanent loss of capital. And in that context, we have a clear cut strategy that all of our fixed income investment will strictly be into AAA rated paper. We will not carry an average maturity of more than 5 years. We will not have a single paper having residual maturity of more than say 15 20 years, a single paper. As of now, you will see we are around 7% into fixed income paper. Most of them are PSU. Then we have around 15% into T-bills and GSEC. Some of them which we have placed with exchange for derivative margin. So out of the 20%, or you can say roughly 21 22% we have in fixed income, almost 17, say 16 to 17% is in PSU. That is either T-bills, GSEC, or AAA rated PSU companies, and hardly 4 to 5% will be there in some of the, you can say, large NBFC papers in our portfolio.
Maintain some amounts in cash when the situation calls for, or is the fund fully invested at all times?
So most of the time we are fully deployed. So out of every 100 rupees we get, 80 goes into equity and 20 goes into debt, because anyways our asset allocation model takes a call which indirectly changes our allocation from equity to hedged equity. Hedged equity is nothing but like an arbitrage kind of situation wherein we are long stocks and short either index future or stock future. So because our asset allocation model keeps on doing it on a daily basis, we look at our signals on a daily basis and take that call. So we don't take any additional cash call in our portfolio. But that 20% which is in debt, it is into very liquid debt. So as and when required, we can easily liquidate that 20% portfolio to create cash.
Bhavesh, how much allocation an investor should put into a balanced advantage fund, considering the core portfolio is already formed, where one has, one is already diversified across all the market caps. Over and above that, you think it is necessary for one to have a balanced advantage fund? If yes, how much of exposure should be allotted?
So definitely, yes, one should have. As I told you, each and every client should have a balanced advantage fund in his portfolio. See, whatever you do, whatever you say, whenever you construct a portfolio, either an advisor or a client himself, or when we advise to some of our clients or some of our distributor partners, our hypothesis or our understanding is simple, that a client is generating, or you can say, a portfolio with different large cap, mid cap, small cap, multi cap, some liquid funds, some debt. The final objective is very simple. Number one, he wants to improve his return. Number two, he wants to reduce his risk. And as I told you, this dual goal or this dual objective can be achieved easily by one single fund, that is balance advantage fund. If you put balance advantage fund in a client's portfolio, say 20% or 25% or maybe 50% for a conservative client, return wise you are not compromising, because over a 5 year period, 7 year period, you are giving him returns which are as good as any, you can say, your index fund or your Nifty, or that is your equity returns. and drawdown and volatility wise, you are reducing his portfolio drawdown and volatility by almost 40 to 50%. So if I adjust it on a risk adjusted basis, if I look at that return, you are almost giving him double the return compared to what he will get in his normal portfolio. So by default, balance advantage fund should be part of each and every client's portfolio. As I told you, for aggressive client, it can be 10-15% of his portfolio, so that in tough time, that 10-15% of the money which will be in balance advantage fund will give him that liquidity, wherein he can average it into his other funds like mid cap and small cap at lower level at the time of correction. And for a conservative investor, rather than putting everything into fixed income and generating say 6 to 7% return, if you put in a balance advantage fund, I think the average 5 year return in this category is between 10 to 11%. So which I don't think, even in today high interest rate environment, none of your FD or none of your fixed income will be in a position to provide for. So in that context, I think it is a win-win situation for each and every you can say set of clients. So I think it should be a must part in each and every client's portfolio.
Exactly. So you can earn more than a fixed deposit and also mitigate your risk. Thank you so much, Bhavesh, for making time and explaining the details of this one to our viewers.
Thank you, thank you, thanks very much for having us. Thank you.
And we will slip into a short break, but then after that, let's talk about presumptive taxation. What exactly is presumptive taxation, and how can you opt for it? All the minute details coming up with Preeti Khurana, Chief Editor, Clear Tax, after this break.